Okay. So there's two main scenarios I want to talk about today regarding potential bearishness. Now, here's the thing. I've tried to outsmart the markets for years, where I would look at a fundamental play or I would look at a fundamental opportunity and I would get really, really fixated on it. I would get stuck to that bearish bias. I would see three reasons why the market has to crash, and I would just convince myself like this is it. The market has to crash, because I saw these few things. With the years of experience I've had, like the wisdom I have now is don't try and predict the reversal of the market. Trust the trend until it ends. And so I'm going to mention a few fundamental factors that I'm watching that could potentially lead to a pullback in March, but that doesn't mean that I'm marrying that bias because if everyone's expecting some pullback, if everyone's sort of getting scared and starting to step out of the markets, that doesn't mean the markets turn around immediately. Typically, and this is where I got caught in the past, is the market will spike all the early sellers out, continue to move aggressively to the upside until there's no more sellers, and then have that release. So number one, or here's the few rules. If you're going to be trading the reversal, or if there is a reversal or a pullback, not saying there will be one, but this is just to prepare before I go through the options, is keep risk management in check. Because if you're trading against the main trend, you're taking, by definition, you're taking an outsized risk. You're betting against the market, typically lower probability trades. Yes, there's a massive payout if it works, but that's the if it works. The second one would be don't marry the bias. Okay, don't marry the bias means if the market continues to push to the upside, don't keep convincing yourself, oh, it's got to drop from this level. Oh, it's got to drop from this level. It's got to drop from this level. Guessing the highs is the easiest way to give back all the money we made in the bullish market. So as I explain some of the fundamental reasons why there could be a turnaround, just keep in mind that there are still rules to trading reversals or to trading a big market pullback that might be different than your day-to-day rules trading with the trend. So we'll cover those. I want to cover the Bank Term Funding Program, which is the treasury facility that was opened last year to be able to bail out regional banks that were dealing with liquidity issues. It was around March of last year, if I'm not mistaken, they opened that up, and it's about to the bank funding program is about to end on March 11th. So what does that mean? Basically, what is this? Is this 16 billion or is this 160 billion? Trying to figure this out. 164,000 millions would be, so 231 million, 4.2 billion, 64 billion, 164 billion dollars. So yeah, about 164 billion dollars was pumped into the economy in the last year. So a lot of folks were asking me, if the Fed raised interest rates, how come the stock market isn't crashing? Like if they started quantitative tightening and pulling money out of the economy. Wait a second, why is this private? Bro, come on, man. What the hell is this? No wonder. I was like, there was nobody waiting on the stream this morning. Okay, whatever. So the Big Term Funding Program, they pumped about 160 or 170 billion dollars. Folks were asking me if the Federal Reserve implemented quantitative tightening and they're raising interest rates, how come the economy isn't feeling more pressure, or how come markets are still just as liquid? The answer is because for every dollar that they took out of the economy during quantitative tightening, they put right back in to bail out the banks. And so one of the bearish perspectives right now is because the bank term funding program is coming to an end, liquidity will dry up in the system, interest rates are still high, and so the banks are still exposed to the same risk. This what the banks are dealing with is duration risk. Typically, they buy a bunch of treasuries or a bunch of bonds, and they expect to hold them until maturity or until a later date. Now, if the interest rate is going up, the value of those bonds is dropping significantly, even though the rate they're getting paid is higher. The value of the bonds is dropping. And if they have to liquidate a lot of those assets to pay back a few investors or to pay back some depositors, because there's a bank run, a lot of people are trying to pull their money out at the same time, that crashes the bank. And then it brings down a bunch of other banks with them. We saw it last year with Silicon Valley Bank and what were the other ones? I'm spacing on the names. You guys know which ones I'm talking about. By the way, NAS pullback in motion, keeping an eye on this, looking at 17,920. If we break 17,920, then 17,900 is where I'm buying. So we're either buying from 17,920 or 17,900. So there's a 20-point range here for potential longs. All right, I'm going to wait for the market to get here, wait for it to dip just below the zone, and I'm going to enter right below this area. When it comes, just a quick side note for trading, I may take a break from trading in March, or I might paper trade in March, mostly because I'm busy. I'm going to be on tour, mostly because prop firms are in this gray area right now where no one knows what's going to happen. I've heard a lot of talk about futures prop firms. I see that they're all throwing out big deals. I need you guys to be careful with these prop firms. Futures firms are not exempt from regulation. They're managed by the same exact regulatory division at the CFTC as the Forex trading. So if we're going to be kind of putting all of our eggs behind futures prop firms that are servicing US clients or prop firms that are switching from meta quotes to DX trades, if you guys don't think that DX trades is going to get the knock on the door the same way meta quotes did, you're not paying attention. So none of these platforms are, none of these platforms have an exemption. None of the prop firms or the futures prop firms got some special exemption to operate in the US. So as much as I want to support the prop firm space, taking a couple of weeks off and then not rushing it is going to be in your best interest. That's what I'm doing personally. So Apex, Top Step, My Funded Futures, they all have a lot of potential, but at the same time, they haven't gotten any permission to operate that would allow me to think that they're exempt from the regulatory oversight. So futures prop firms aren't regulated? No, they're not. If they say they are, they're lying to your face. There's only a few regulated prop firms. And if they are regulated, they can't serve US clients. It's that simple. All right, we're getting a pretty aggressive drop here. I'm going to wait for one more push through the zone to get in. One more push. I'd like it to come down to maybe 915, just a little bit lower. Probably 5 to 7 more points. You can start layering in trades here. All right, so I'm going to wait for a rejection here. It's the market open. We're about 11 minutes post New York session market open. He said, wow, good to know. Yeah, the marketing for these prop firms is, and it's the same with all the unregulated brokers and offshore brokers. Everybody says they're regulated. That's like the catchphrase of the month. You ain't regulated, right? They'll be like, oh no, I have a license from the British Virgin Islands or, wherever else. It's like US clients are the ones getting kicked off. It's not that these companies are going under. It's that US clients are not able to trade on these platforms. All right, looks like the dip is coming. Oh, so the second fundamental thing is all the big shareholders selling stock. So Bezos and Zuckerberg selling records amounts of stock for Amazon and Meta. That typically leads other investors to start following their pace because these guys time the top of the market when they're selling their stock to be able to pay back loans. They have a really, really good sense of when to get in and when to get out. So if there is a potential pullback in March, that's going to be a big driver for it, which is some of those top names selling. All right, I'm going to enter on my phone here, but I'm going to try to enter this paper trade to keep everybody to have a visual here for everyone. Actually, give it a sec. No, I'll scale in. All right, I'm entering my position on my phone, and then I'm going to try to do these at the same time so I get a similar entry. So the first position that I'm putting in, I'm doing it on my phone. Hold on. The first position I put in the morning is always small. So if you're thinking about throwing a standard lot size, cut it by 3/4. Like cut it to 0.25. And then as the market gives you better entries, you can layer in. And so if you were thinking about putting a 1.0 all the way up here, you can put a 0.25, and then you can put a zero point 0.5 down here. And then as the market dips a little bit lower, you can put another zero point 0.5 or even larger. Because as the stop loss, the point count decreases, you can use a larger position size while maintaining your risk management. Okay, so this is looking pretty aggressive, more aggressive than usual for market open. Let's take a look at Forex Factory, see if there's anything going on. So we had the S&P Composite 20 HPI, the price of single-family homes in 20 metropolitan areas, the house pricing index. Wow, that's not good at all. Massive inflation. Durable goods orders down significantly, and then definitely missed expectations. Wow. Huh. So people are buying less durable goods. It typically results in less manufacturing, less consumer demand and consumer spending. And so this is an early indicator of consumer demand. Because if less orders are coming in to the manufacturers or to the producers, that means eventually there's going to be less, like they're seeing less demand coming in. And so they're just kind of preparing so they don't overpile their merchandise or their inventory. We also have consumer confidence dropping in 15 minutes. This is going to be a big one. If we have a miss in consumer confidence along with these other negative data points, we definitely see a bearish start to the week. Okay. First order is placed. Again, small order. I put it on my phone, and I got a better entry on my phone than I did here. There was a deal. There's deals that are being thrown around by all the futures firms. And so at the end of the day, there is what I would consider that is a low risk. Uh, what does it say? Like it's like a low risk chance. Because we know that I think that futures firms have a little bit more time than the Forex props. So I'm not saying they're going to be down next week or the week after. They might survive, I don't know, 6 months before they start to have issues on the US side, which by that time, I'm sure that prop firms will have figured out the regulatory environment. But they were doing a 90% off deal or something, which to me I found a little bit fishy, but I think they were just trying to attract a lot of attention. Um, so yeah, it was like a low cost risk to just pile up a few accounts and give futures a try. That's going on. Well, now we got people in here. Is it possible for NAS to take the liquidity that's below, like that double bottom? Yeah, of course. For sure, for sure, for sure. All right. Let's go through DXY. So DXY, we talked about this on Sunday. If you guys aren't paying attention on the Sunday outlooks and you're sort of like forgetting what we talk about every single day and you're trying to do something from scratch, you really haven't understood what your job is as a trader. If you do your analysis on Sundays and you look at the higher time frames and plot your higher time frame levels, as long as the market is respecting those levels, you shouldn't have to change shit during the week. So we talked about this on Sunday, which is that we broke above this key level on the DXY. The market had established a new high compared to this previous high. And then the market was starting to slow down its bearish retracement. The candles were slowing down. Beautiful liquidity grab inside the range and break back above. And then we have a ton of these daily candles closing above that range. So I'm seeing a push to the upside to 105.8, which should help EU and GU continue their push to the downside. Same with gold, potentially. The reason that I was kind of hands off on really calling anything on gold and this is especially true for last week, is that I saw the inverted head and shoulders start to form. And then we saw this beautiful impulse as a result. And so even though it kind of looks like there's a double top forming at this resistance, And it could be very attractive to start selling from here, okay, because of the 78% pullback double top. I'm still seeing structure forming higher floors and higher ceilings. And so until we break either this floor or this floor, I don't really see sellers taking back over. But once we break that area of structure, then we can start looking for a quick pullback. So it'll go like this, break of structure. You wait for an 80% pullback of that impulse, and then you can short on the retest. All right, gold traders, you guys know what you're looking at. For me personally, I'm just looking at the higher time frames, shooting the shit, but I'm not trading gold, and so take that with a grain of salt because I don't have any skin in the game on that trade specifically. This one I just have on my charts just for fun. Someone asked me to look at this a while ago, almost at TP. This would have been the swing trade of a century. This was called back in December, like 3 months ago, damn near. Euro USD. Obviously, this one's dependent on what the dollar does, but I'm seeing this potential pullback right now from 1.085 down to our 1.05 target. So I'm still bearish on Euro USD. US 30 on its way down for a pullback. Let's go like this. So we had this nice kind of reversal pattern. I'm going to use a little cheat code here, the reverse fib, to find my buy entry. Beautiful. Get rid of everything else. So ideally, I'd like to see price break through the 38,800 level and then break back above. As soon as it breaks back above, I'm just going to wait for a retest and then enter the first retest. So wait for the liquidity grab through, wait for the recovery, buy the retest. It's not rocket science, people. $38,800. $38,800. So I'm in profit on my personal account on this trade. Shout out your entries if you guys took this trade. I'm going to protect this thing here soon. Good morning, Garden Scientist. Garden Scientist. But what the fuck did I just read? T, that's your people's, bro. That's both. That's the best of both worlds. Do you think US 30 will retest 39,000? Just covered US 30, so you guys can check back in the recording. Okay. Beautiful. Uh, 916. That's down here. Oh, nice. All right, and now it's a patience game. I am going to move my stop loss just below this wick right here. Well, I mean, it's basically where it's at. Right now, it's about 30 points of risk. There's a ton of stuff, by the way, in case you guys are starting to trade futures, keep in mind that most of these futures firms have a trailing drawdown rule. So the difference between equity-based drawdown and balance-based drawdown is like on FTMO, if your starting balance is 200,000 and you're down $10,000, okay, you're down 5%. You still get to keep your account, you still get to keep playing. If you're in a trade and you're up $10,000 and it retraces all the way back to entry, you still get to keep the account. With futures, it's not like that at all. Equity-based drawdown is one of the stupidest fucking things I've ever heard of in my life. If you have a trade that's running $5,000 or let's say $10,000 on the 200K account, and the trade goes back to entry, it retraces back down, and your equity draws down by 5%, you violate the rules and they take your account. The trade could be a winner. Your equity could still be above 100K, or sorry, 200K. You could still be above break even in your equity. But it's just because of the fact that it retraced back to entry, you could lose the intraday trailing stop loss. So make sure you guys understand the rules when you're trading with new platforms or when you're trading a new instrument, because that's where a lot of these issues can come in. Now, how do you get away from the risk of that equity-based drawdown or the intraday trailing drawdown? We at Chart Addicts have by far, and guys, if you don't believe in a God, let this be it, okay? Because this strategy that we developed is absolutely perfect for futures and for equity-based drawdown. We take partial profits at predetermined levels. The intraday trailing drawdown hurts people who don't have clear targets. We're just sort of holding and expecting the trade to keep going. When you know exactly where you're getting out, you can unwind the trade, you can de-risk the trade, you can protect it, you can reduce the amount of exposure, and in turn, you remove the risk, or not really remove the risk, but you reduce the risk of ever hitting that intraday trailing drawdown. So that TP1, baby, that TP1. All right. Everyone was trying to give me shit for, oh, Rule, you got to hold your trades longer, hold your trades longer. How you like them apples? We built all the right habits. We have the perfect system to be able to take advantage of those rules. Even though it's a stupid rule, we're still prepped. I was up 5K yesterday on 100K, and it retraced and failed me. Learned quickly. Well, Jay, now you know. Okay? Everybody here, use that as an example. And Jay knows how to trade. It ain't about how good you are as a trader. On Apex, it's better to get multiple 25K accounts instead of the biggest accounts because of the max trailing. You can get up to 20 accounts at one time. Yeah, but it's the same thing. You're either going to risk a small amount on 20 accounts and you're going to have to link them and copy trade them and all these other things, or you can just put similar risk on one big account. I don't understand that one. It's the same thing. I think letting a 10K or 5K trade go back to zero is pretty wild. It is, but like you guys got to understand that most traders, most of the big name traders I know don't day trade. But I met this guy in Dubai last time I was out there. This guy takes like 6 trades a year. He's holding some of these positions. Obviously, he's waiting for higher time frame place to set up. He lines up fundamentals with swing trading strategies and kind of like technical analysis to find market shifts. And so, yeah, he's holding it. Like if you're up 5 or 10%, but you're that kind of trader, you don't have any interest in closing a trade that you know has potential. And that's how they make all their big money. So I understand why, why that rule would hurt a lot of people. For me, the only thing that gives me trouble with is the runner. Because I'll take my intraday profits at those TP1, TP2, but if I really look through my results, it's the runners that make up for the risk and reward. It's the runners that really, really pay, because some of those go for 5-1, 7-1, as opposed to the original partials I took, which was 1-1 or 2-1. You guys get where I'm going with this? So either way, if you have a good system, all you have to do is adjust your risk strategy to whatever platform you're using or whatever instrument you're focused on, and you can make it work for you. So keep your head up. Make sure you master how the markets move and master yourself and your psychology. If you do that, being adaptable is going to be a lot easier, which obviously is the name of the game. Okay, so some folks got entries at 917 on the stream. Some folks got entries at 920 and 900. Good stuff. CA members, let me check right here. We got 909, of course, Roman. Great EU call from Sunday. It's playing out. Oh, let's go, two-step. All right, Mike got 918. T got 944. But what type broker you got 944, bro? Chris Breezy got 920. Shan got 951 on Top Step. Okay, so I'm guessing the futures prices are higher. And then he got 923 on CTI. Awesome stuff. And that's the pump we're looking for. Beautiful. You guys can protect the trade now. We're floating about 40 points. That's above a 1-to-1, if I'm not mistaken. Yep, we're at 1.3-1. You can close the whole trade for a 1.3. or you can secure partial profits and then protect your entry. If it continues to run, perfect. The R&R will make up for it. If not, then at least you walked away with some partial profits. Personally, I'm going to be closing partials right now. And I'm going to move my stop loss. It might be premature to move my stops to break even. Depends on what kind of day I'm trying to have. I got a pretty busy schedule, and so I'm not going to be here to re-enter this trade a bunch of times. And so, and by the way, this is what's so counterintuitive. Because back in the day, if I had a busy day, that was motivation for me to protect my trade. Because I wasn't going to be watching it. I didn't want to have a position open, just naked, no stops and break even. But now it's the exact opposite, just to show you how counterintuitive trading is. Because I'm not going to be here to re-enter, I know the market's going to come back to my entry at least one time before it hits TP3. We know this. The market pushes up. You think that you're golden. A bunch of new traders are piling on buy entries right now. And then the market retraces all the way back to entry, grabs liquidity, and then goes back up. So because I know that's a possibility and I'm not going to be here to re-enter, I'm going to secure my partials, but I'm going to leave the trade open. Cool? Make sense? Some quick maths. If we're floating at 1.3, right now we're floating at 1-to-1. If you close half of your trade, okay, it was basically a 0.5 to 1 risk and reward. So if you risked $1,000, okay, right now you should be floating $1,000 on your screen. If you risked $100, you would be floating, well, right now you'd be floating about $115. So if you close half of the trade, you'll be floating about $57 in profit, and then you'll have closed $57 in profit. Okay. Oh, damn. Well, now we're at 1.7. Never mind. Now we're at 2-to-1. I'm closing partials again. Good stuff. Secure partials again, folks. That's what I'm doing right now. This is not financial advice. Please do your own research. This is strictly my opinion. This is just my right to exercise my freedom of speech, my First Amendment rights here as a U.S. citizen. But I did secure partials again. All right, so if you go for a 2-to-1, then you're floating $200. You get to bag $100 and put this in your account. That's now your part of your balance, and you still have $100 floating equity. Now, let's keep that in mind that you have half of a position running. If the market goes 3.6 to 1, but you have half a position running, so you risked 100, you closed half. Now you still have $100 running. Or sorry, the $50 from that original trade. 50 times 3 is 150 times 3.6. Fuck, I hate math. It'll be like 160, 170. So by the time the trade finishes playing out, you'll make an additional 170 on the runner. And so you get to make $100 on the partial profits that you secure. And then if the market hits that TP3, you make another 170 for a total of $270. If you risked $100 originally, then your realized risk and reward, your realized return is going to be 2.7 to 1 R&R. So the reason I go through this example is because your theoretical or your expected risk and reward is 3.6. But when you close partial profits, you're not realizing the full amount because you're not holding the full position anymore. And so it'll come back to 2.7 to 1 as opposed to 3.6. So always keep in mind the difference between the intended R versus the realized or the real R&R. Okay? Big stuff. This is the difference between theory and practice, people. That's why some people can learn a theory but not get the right results, is because let's say that you're learning something only on a backtesting feature. Right? That's why I'm actually not against demo accounts for practice, even though a lot of people say, oh, you should practice on live so you can feel the real emotion. I think there's 2 steps before live trading, or 3. Number one is education. Number two is simulation. So you have to simulate the strategy on like in a protected environment. So like a demo account or some kind of, something like that. But I would say a backtesting feature comes first, but that doesn't include spreads, swaps, commissions, slippage, or any of the real market conditions. That's why we're partnering with FX Replay to do the trading challenge at the summit this year, because they have by far the best backtesting software, really in-depth, real live market conditions, down to the 1 minute, 30-second charts, and they have data going back 20, 25 years. So you want to use a backtesting feature that has those real conditions built in. Then you want to do a demo account to simulate those live executions. So you can see, how do I get filled? Where is my entry price? What are the fees associated with holding trades versus closing them early? And that'll give you a good idea of how to trade on specific platforms. And then you jump onto live trading with small positions to get comfortable with the mechanics, to get comfortable with the risk management. And then when you have this thing down, you scale up. Very simple stuff. Juicy J says TP1 hit. I think more than just TP1 hit, I'm going to be honest with you. TP2 hit. TP2 got smashed, actually. This is where we can expect a pullback to entry one more time. So it's either going to fill this wick and crash. And by the way, news just dropped for consumer confidence. Bro, damn. Another miss. I mean, this is the first miss since September. So it's not the worst thing in the world, but it's just not a good day overall. And something to understand about cycles, because we always talk about liquidity cycles, especially as it relates to the annual market cycle. How do markets react to different points of the year? See, around tax season, and at the end of the year, we typically see sell-offs as investors sell at a loss to kind of offset their tax liability. We see how market participants react to different stimuli. Right now, obviously, there's those big fundamental factors I mentioned, which is the largest shareholders in the world selling stock. It's the middle of earnings season, which we're kind of in the middle of right now. And then we have the bank term funding program ending March 11th. Tons of stuff happening that might make the market react. But we also have a lot of the good numbers, because we've had great data coming out from January to start the year off. A lot of the great data comes from a seasonality effect. So January is typically a busy month. There's a lot of economic activity. It's a new year and everything else. And so we're going to see if a lot of the good, sort of the good sentiment that we're seeing is from seasonality, or if the economy really is on track. Now, if you ask most mainstream, what is it called? Commentators, they'll tell you the economy is close to cracking, right? The crash is coming. Armageddon, right? Chicken Little, the sky is falling. But I was having a great conversation with a good friend of mine, Bob Elliott, top economist, former head of the investment team for Ray Dalio at Bridgewater and Associates. Absolutely brilliant macroeconomist. He deals with global macroeconomic themes and dynamics. He told me that the US economy is solid. He said all that doomsday stuff makes no sense. The data does not support it. You look at the labor market, folks still have jobs. You look at the inflation reports, the rate of inflation growth is slowing down. You look at the GDP, which I believe there's a GDP print coming out tomorrow or Thursday. GDP is still growing. So, like, look, you guys, I wrote an article about this year, kind of going through my two biggest ideas. Number one is that market reality finally hits. Everyone realizes, oh, we're not going to have 8 rate cuts this year. Jerome Powell was dead serious when he said, we're not going to get 7. We're probably only going to get 2 or 3. And that we're going to have this crash as the market realizes that regional banks are at major risk and there's geopolitical escalation happening in Russia and the Middle East, and a lot of the uncertainty surrounding the elections, etc. And then my second theory I thought was just absolutely nuts. I was a conspiracy theory. I put my tinfoil hat on and I came up with about the best idea I could. I had the antenna locked in. And my theory was it's an election year, and Biden and Janet Yellen are best friends. And Biden and Jay Powell, I wouldn't say they're best friends because Jay Powell wanted to retire and Biden forced him into another into another term for Fed chairman, which I really feel bad for Jerome Powell because fuck is he in a tough spot. But Janet Yellen and Jerome Powell are best friends too. So you have the head of the Treasury, the piggy bank of the United States, the head of the Federal Reserve, basically the money printer, the unlimited money printer of the world, not just the US. And you have Joe Biden. Would they keep the economy stable and not do anything drastic to crash the economy simply for political reasons? Is it possible that one of our great US institutions has been politicized? I think so. Some people might call me a crackpot. Some people might say, Roy, fucking been watching too much Alex Jones. You're right. But if you look at the data, I don't know. Seems like they're intentionally propping up the economy using the Bank Term Funding Program. And we can go through that here, which is, you guys can see, this is just a quick, I'll give you like a 45-second overview here. This is the balance sheet of the Federal Reserve. Those of you guys that are not really economics minded, first off, take the fundamentals course that we have on our website. It'll change your life. Number one, it'll teach you about fundamentals, so you're now a competent practitioner in the markets. And then the second side is how to trade news events, which a lot of people seem to want to stay away from. People are scared of. It's the boogeyman. People get on, if you trade news, you're an idiot. I used to say the same thing because I used to lose a lot. And then I stopped trading news and I started making money. But then I realized how to trade news and I realized it's just another day. I'm not even looking to make more money. I'm just looking to make it faster today. Instead of waiting for 2 or 3 candles on the 4-hour, I can just have one 15-minute candle do the job for me. So if you guys are interested in that, it's on the website. You can find it under courses. But let me just break through. The balance sheet is just a snapshot of how much assets versus liabilities you have. So you can look at your personal balance sheet, which is your assets, your car, your house, whatever assets you own, and then your liabilities, which might be a mortgage, which might be debt, consumer debt that you have, or credit cards that you owe, or student loan debt. And you see your balance sheet where we're sitting at. Most Americans have a negative balance sheet, plain and simple, because the average debt per citizen is insane. Now you look at the total assets. We printed, this is $4 trillion pre-pandemic. Post-pandemic, the market or the balance sheet was up at 7 trillion. Okay, so from 4 trillion to 7 trillion is about $3 trillion, double the balance sheet. So they doubled the amount of money that they had in the balance sheet in 1 year. And you guys can see that the 2008 financial crisis, which I studied in school, they told us it was the biggest financial crisis the world had ever seen. Okay, the balance sheet before the financial crisis was under $1 trillion. After the financial crisis, during the first quantitative easing facility where they first started printing money, the balance sheet went from under $1 trillion up to $2 trillion. The 14 years, whenever you guys hear me talk about how the market was in a party because of the money printing for the last 14 years. Let me see if I can secure partial profits. How do I secure partials here? Partial close. 125. Beautiful. Okay, so you guys always hear me talk about this party that's been going on for 14 years where there was free money. And a lot of you guys are old enough to have been around for 14 years and you don't remember any free money. When I say free money, it's when you go to get lending from banks, there's different tiers of priority. And so if you're a tier 1 customer of a bank, you are high priority, you're one of the top creditors. They call them prime creditors. You're going to get the best interest rate the bank has to offer. So banks were borrowing from the Fed at 0%, lending it to the world at anywhere between 1 to 5%, depending on what you were borrowing for. If it was credit cards, it was as high as 10%. And then they were just paying back the Fed the same exact balance that they borrowed. So you borrow $1 billion, you make $100 million on it, you give them back the $1 billion, but you still got to keep the $100 million in profit. And they were just doing this for 14 years. Now, with all of that happened, with the iPhone coming out and Facebook and Twitter and all these companies going out and Tesla, the balance sheet went from 2 trillion up to 4 trillion. From 2 trillion to 4 trillion. It doubled in 14 years. The pandemic, in the span of 3 freaking months, we went from 4 trillion up to 7 trillion, almost double in the span of months. And so the fun stat I like to throw around here is that 30% of all the dollars in circulation were printed in the last few years. And then this is obviously what led to the inflation crisis. Why does everyone know what inflation is? When I was growing up, when I was reading all these nerdy finance books, nobody freaking knew what inflation was. My mom texted me asking me about inflation. That's when I knew we were fucked. My mother asked me, I love you, Mom. My mom doesn't know about inflation. Well, I mean, she knows about it. She's been shopping long enough. She knows. So whenever I start to see the mainstream media start to catch on to these themes, I realize how big of a problem it is. They tried to unwind the Fed's balance sheet. Okay, starting in mid 2022. This was quantitative tightening, the first facility of QT, the opposite of money printing, which was like a vacuum to the money supply in the economy, trying to take it back out. And what they do is they essentially force the banks to buy back a lot of the assets that the Fed bought from them, and then they just literally take money from their balance sheet, or vice versa. They force banks to buy these certain assets, and then they take cash away from the banks. So whatever they have to do to remove cash from the system by forcing banks to either buy or sell these duration assets, whether it's treasuries or mortgage-backed securities, whatever it is. They ain't do shit in a year. All right. So yeah, they could print $5 trillion or $3 trillion in the span of 2 months. But God forbid they do anything to reduce the balance sheet. Look, in the span of a year, they went from 9 trillion down to 7.5. Okay, so we dropped about 1.5 trillion. We're still above the COVID highs. And so a lot of people are asking me, how come this hasn't been dropping more? It's because they were taking out 100 billion. Okay, they printed trillions, and they were only taking out $100 billion a month. So if you're taking out $100 billion a month, that's only $1.2 trillion a year. That's going to take us 5 years to undo all the money printing that they did, at least. So I was like, okay, 5 years to get back on track and to not run into a brick wall. Fuck it, we'll take it. And they started printing money. Exactly a year after they started quantitative tightening, they started printing money again because a few regional banks were going to go under, and it was going to become a systemic risk. And so they started printing trillion or billions of dollars, $80 billion in the span of a month, $100 billion in 3 months. Okay, now the bank term funding program is sitting at 170 billion. These are loans. So let me now just say that this is money printed that's just going to go out into the public. This is not stimulus checks. This is loans that will have to get paid back. Some of the doomsday folks that are talking about the BTFP, the Bank Term Funding Program, are saying that because the facility expires in March 11th, that the loans are going to come due. Not true. About 20 something, I don't want to get this wrong, but 25 to 28% of those loans are going to come due. The rest have a different duration. And so this is not going to be this whole fucking emergency that happens at once. And then here's my next theory. So my 2 conclusions to everything I just said. Fed's been printing money, pumping it into these regional banks so they don't crash. Once the Bank Term Funding Program ends, these banks are still at risk and they owe the Fed money, but they still have the same risks because interest rates are still high. The bonds they hold are still losing value, and there could be a risk for people pulling their money. Those still exist. The Fed will open it up if they need to. The Fed will bail them out, just like they always do. A lot of people just don't pay attention to fundamentals. You want to know why? And I don't blame them. Because the Fed has always bailed everybody out. Why would I bet on a banking crisis when I've seen what happened in 2008 and in 2020? Clearly, these too big to fail banks, or what are now they're now called SIBs, systemically important banks, those top 7s, Bank of America, Wells Fargo, Citi, and the rest, and Chase and all them. They're going to bail those systemically important banks out. Now, if I'm going to make a 5 to 10 year bet, if you guys have your money or your loans or your commercial debt through regional banks, those are going to go under. And the Treasury has made it clear because they're kind of in cahoots. They have a cabal with the top commercial banks. Because if you guys think the Fed really is a representative of those 7 commercial interests, they are the ones who control the interests of the Fed, not the government, even though the government can try. They're going to bail out the big guys and let the regional banks fail one day to try to get all the money and all the flow to the commercial banks, to the large commercial banks. Why? Because those folks, they're eventually everyone's going to go digital. Eventually, there's going to be a central bank digital currency that everyone uses, the digital dollar, and they're going to be able to track 100% of the transactions if you're using the systemically important banks. If you're using a regional bank, you still have privacy from the government. This is like, all right, tinfoil hat is on full. This thing is covering my eyes at this point. But it makes sense, doesn't it? And if you guys don't believe me, go and watch some of Janet Yellen's speeches regarding the bank term funding program, where she specifically talks about how the priority is to maintain the integrity of the national banking system, the federal banks, but not necessarily those regional banks. They bailed out Silicon Valley and the others because they were holding so much debt for Fortune 500 companies that it did become a systemic risk. But that's the thing. And I love regional banks. But at the same time, if they're going to be, uninsured during a crash, then God help us. When we pay back the money to the feds, profits go to the Rothschilds? No, the profits go to the Fed. The profits go to the Fed. Look, the truth is always more boring. Well, actually, it depends on how your mind works. If you're expecting some shit that looks like a movie, then reality might be more boring than your expectation. From my personal experience, reality is way crazier than the monopolies or than the conspiracy theories, but just in a different way. So, is there some guy pulling the string behind the Fed? Dude, no. All right, but think about it, Mike. Imagine you're Jerome Powell. No, matter of fact, imagine you are somebody from the Soros Foundation. Okay, you host a charity gathering, and you're sitting down thinking, who should I invite? And so you invite Larry Summers, the former Treasury Secretary and former head of Harvard, or dean of Harvard, and now he's the head of the finance department at Harvard. You invite a few Janet Yellen, you invite Jerome Powell and a bunch of other folks to come speak to try to raise money for this specific cause. Everything is cool. So you're sitting at the table after having a conversation with Jerome Powell, and it's really hard because government officials, if you bribe them, it is a 100%, it's against the law no matter what. But with elected officials, you can just fund their campaign. That's the easiest way to bribe someone. Look at Nikki Haley, for example. You're Boeing, you can just give her $50 million, or you're Reid Hoffman. You can just give her $80 million to fund a losing campaign. And basically, whatever policies you want passed are going to get passed. These guys will not get elected without the campaign money. With Jerome Powell, he's an appointed official. The government or the president appoints him, and they get confirmed by Congress. So you really can't just go and bribe an appointed official. That's not how this shit works. The corruption happens in the form of these large-scale packages or these large-scale programs that get released where there's not a lot of specificity, and they change the rules all the time. So I'll give you an example. The money sent to Ukraine. When you look at the defense budget and how much of it is unaccounted for, I'm talking about specific expenses unaccounted for. You'll be like, how the fuck do you lose track of $20 billion? But I lost $20 the other day. I was sitting there looking for it for 20 minutes. I was trying to find it in between the cushions. How the fuck do you lose $20 billion? How does that just go unaccounted for? I sent a $300 transaction on PayPal. I got the IRS up my ass. How do you lose $20 billion? And that's where you realize where some of the corruption comes from. It's not just that the money is going to defense contractors to pay their friends. This money is getting lost in the transfer. So when you look at the trillions of dollars that get moved around from central banks through their repo operations, those repurchase operations where they're constantly buying and selling, through these swap lines with other central banks to trade currencies at pre-specified rates and to keep the global currency system stable. If you look at bank term funding or bank term lending, if you look at the Fed's discount window, where the Fed funds rate where the member banks borrow from, all these operations, there's room for money to get, side here to here. But I just don't think that that's happening, only because the Fed is one generation away from losing their credibility. Nobody wants this kind of like monopolistic group of 7 of the largest banks to run our lives. Pre-2008, everyone was happy with it. After 2008, people realized that their banks were not the most trusted institution. People treated banks like they were the church. They were like nobody could ever imagine that the banks would not do their due diligence or the banks were being reckless, as if the fucking history book doesn't exist, as if we didn't go through the Great Depression and the stock market crash of the early 1900s. Like, all this shit has been happening. Banks are sus. We know this. Okay, so the corruption might happen with those folks where they're getting paid way too much money to go speak somewhere. And then you get paid a shit ton of money. And then all of a sudden you pass a specific regulation, you support a certain group, you bail out a certain bank, and you're like, why would they bail out this bank versus another bank? It doesn't really make sense from a strategic point of view. And you realize they're buddy, right? Your boy calls you middle of the night. Hey, man, my whole shit's going under. I need help, right? You're the only one that can help, right? You're about to send out $1 trillion to all these banks. Why don't you just throw my name on the list? 20 billion here, 10 billion here. Just throw my name on the list. And that's where a lot of the backroom deals happen. Guys, if I get picked up by guys in suits, tell my family I love them, right? You'll never find my crypto wallet, so don't fucking try. And lead with love and accountability, right? If they come and scoop me up, just know I loved you guys. Just know that I did this for us, right? If they come and scoop me, just know. I mean, ideally, I end up like ICT, right? I get abducted by market makers. Whoop, whoop. I said, I didn't do it. I didn't do it. I didn't mean to say all that. They're like, no. We're not with the Rothschilds. We're with the NASDAQ. You know what I'm saying? We're with the market makers. I said, you've made it. It's like, you guys know Harry Potter? He's, oh, you're a wizard, Harry. He comes like, they chose you. That's how I want it to happen. That's what ICT said. It's the playbook. I'm about to get myself in so much trouble. If this is your first time on the stream, I hope you're being entertained, right? I'm out here geeking myself this morning. I follow your free stream for a few months. I only trade NASDAQ. With your strategy, I've reached 3 funded accounts. Thank you. Well, Martin, good for you. Congratulations. Reach out to us and send us some of those results. We'd love to talk to you and potentially do a podcast with you if that's something you want to do. Ain't nothing wrong with my guy, Alex Jones. I love Alex Jones, bro. People give him such a hard time. It's like, buddy, you're not going to have 100% hit rate. But if you look at the propaganda campaign that's been set against him, if I was a very important person and I was trying to take attention away from myself, I would go all in and crush the one person that's actually telling the truth. I've been in those shoes. I understand it. If you read Too Big to Fail, you'll understand how accurate the theory is. Exactly. And you see how like systemically important banks versus too big to fail. Too big to fail makes it seem like the government was asleep at the wheel and they allowed these companies to get too big for their own good, which is exactly what happened. Isn't that crazy? Assets minus liabilities equals operating expenses? What? Operate earnings? What the fuck are you talking about, Sam? Also, what's good? Sandro sniper emoji. Sandro the Great. Is this somebody from? He says, shout out Mama Dukes. What did you miss out on the crypto move? Josh, I don't miss a fucking thing. Okay. If I am not involved in this current crypto bullish run, this impulse on the weekly time frame, I don't mean I missed nothing. Nothing gets fucking past me. I make a choice to walk away. He said, don't forget about the meeting at 11:30. Bro, I got my eye on the clock, baby. I'm on 2 hours of sleep, sharp as I've ever been. Excited to have a conversation with one of the smartest minds in financial history. the guy who founded Oanda, the price quote that I'm literally using right now. And this man founded Oanda in 1996, which is the year I was born. Guys, put this into context with the individual I'm about to have a conversation with. He started Oanda in 1996, which is the year I was fucking born. You guys know how sometimes I get facetious and I'll say, right, like I was trading NASDAQ when you were still in the womb, right? When you were still an idea, when you were still half a bottle of wine, right? I was trading NASDAQ. This guy started Oanda and secured the largest banks in all of Europe as his clients, made billions of dollars for that company, and made it one of the largest Forex brokers in the entire globe still today, the same year that I was born. What the fuck, man? All right, excuse my language, but this is just, it's crazy to me. And I was always a big fan of Dr. Olson, reading a lot of his early papers about democratizing access to markets, which is something I'm a very big believer of, with my whole philosophy around money and why I do any public service at all regarding trading is because giving access to the most people to have opportunity to make money is the goal. I'm not going to promise everyone's going to be successful, but everyone should have the chance to access the financial markets. Because if you are capable and you have the personality, you have the competence, you should be able to access this market and you know, change your life. So big fan of him. I'm a nerd. Looking forward to asking him a bunch of questions. Anything you guys want to ask? The guy's a PhD. He's a professor at the University of Zurich. He's the founder of, right now, he's the founder, obviously the founder of Oanda, but he also started a no-fee crypto exchange called the Luke, which is basically like a Binance competitor with lower fees. So any questions you guys want to ask? I'm going to ask him about regulation. I'm going to ask him about prop firms and what he thinks about what's happening right now. Offshore brokers versus onshore. I'm going to ask him the hard questions. But give me some of the hardest questions you guys think, you know, you guys think that that I should ask, like some of the harder questions, or just give me some questions you think would go viral. All right. If I was to do this, if you guys were to scroll through and see a reel with me and a boring looking older man who is an absolute genius, but may not have that same charisma, what would, you know, what information would just completely shock you out of your seat? Be like, damn, I can't believe he asked him this. This is something you would expect to ask an influencer, but not Dr. Olson. Thank you, Roy. Just closed the trade at 17,993. First profit this week. Let's go. Love to see it. To be clear, the Oanda prop was a bust, right, Roy? No. Okay, so that's the thing. Dude, that's the thing. There was rumors because when I reached out to their team, they were trying to deny it. Fam, I went on their website 2 days ago. They had written a blog in January 22nd confirming that Oanda Labs was real. It is real. They started an offshore entity. Now, the thing about Oanda Labs, because I was looking into this now, because I'm really excited about this. It's overseen by their global markets division, which is for international customers only. So if you guys don't live in the US, check out Oanda's prop firm. If we're going to talk about who the most legit is, FTMO was up there with their professionalism and everything else. Fam, if Oanda's stepping in the game, RIP to everybody. Now, it depends on the price of their program, because at the end of the day, you can expect the institutional guys to not understand what customers need because they're so out of touch. They might just overprice the shit, okay? But yeah, it's 100% real. Crazy that they're stepping in the game. And that they're a Malta entity. So like a lot of this talk about how some of the offshore guys in our space are registering offshore and everything else. It's like, dude, who the fuck isn't registering offshore? You had FTX, which was a $100 billion crypto company that was registered in the Bahamas. Horrible example because obviously they went under. But you got to realize the regulatory environment in the US does not allow for people to do the right thing. Like that's why the global markets business for all these companies is bigger than the US and will always be. Something about regulation in America is extremely broken. Right? It's like having strict parents. Everybody here has had two kinds of friends, or you've been the kind of person. You have overly strict parents. What happens is a lot of shady stuff. you start to become a lot better at sneaking around, at lying and doing all the shit because you're going to do it anyway. People are going to trade anyways. We just all get better at using, VPNs and all this other shit that people are doing now. So that's why they should, like, that's why they got to deregulate. So having too strict of regulators definitely causes people to do shadier stuff. Having too loose of regulators, that's where you start to have the consumer protection issues, where companies and snake oil salesmen are taking advantage of customers because just desperate people are looking for a chance and they just don't know better. So we kind of have to find this middle ground where the regulators understand the importance of US dominance when it comes to innovation and are willing to allow the startups to build. What I think is happening here is they allowed the startups to build, waited just long enough for them to, start dipping into their market share, because you can assume that these prop firms, the prop firm industry total, if I was to add it up from start to finish, including the influencer commission structures and everything, is a $10 billion industry. $10 billion. That was big enough to finally get on the big players' radar because it was now affecting their market share. And I think that the big guys are kicking out the local props just so they can step in the game, so they can clean up shop and they can be the big players. It's fucked up what's happening, but at the end of the day, we adapt and we need, we need to find a middle ground between the strict parents and the parents who just don't know what the fuck is going on, just checked out. ICT equals I can't trade. I wouldn't say all that. ICT capper. Okay, look, I'm not gonna do all that because, like, look, you guys got to realize how many successful people have come from ICT, and he sort of trades a proprietary strategy, not a proprietary strategy, but whatever. Clearly, something there works. Now, whether it's working for him, I'm not here to, that's not what I'm going for. I'm not gonna call somebody out on things that, like, I haven't watched any of his content. I'm just be honest with you guys to be able to tell you what the deal is. But what I can tell you is, if you say a goofy ass story that just does not make sense, it's just the way it is. I'm gonna have to call it out. I'm gonna have to say something. I'm not even calling it out like to reprimand him. I don't give a fuck what he does. It's just more like abducted my market makers, dude, for real. Josh said, ask him what the best cereal in the world. Yes. Let me get the smartest man alive, senior mathematician, PhD, on a call and ask him about fucking cereal. That's a great question, Josh. Roy, can I have your Lambo? Do I look stupid enough to have a Lambo at where I'm at in life? Because I was a professional wealth manager. I understand everyone's like, get the Lambo and live your life and do all this stuff. Da, 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 da. I've met more influencers from the Forex space that bought supercars and are now in debt or rented a lifestyle that they couldn't keep up with or had to sell a car to pay off this and that than I have met people that still own their supercars. Just gotta throw this out there for you guys for fun facts. Right? Some of these guys are still posting pictures from last year, pretending they still have some of these cars. Like, look, focus on trading, focus on your family, focus on being able to take your fam on more vacations this year. Focus on being able to negotiate less hours at your job so you have your time back. So you don't have to overwork yourself. Focus on making enough money that if your job is disrespecting you, your humanity, your dignity, you don't have to stay there and just eat shit because you have a family to support. You can focus on your progress, and then you're able to leave because you have, trading as a cushion to help you take another job that might pay slightly less. Did you hear about top tier switching to trade locker only? Yes, I did. And unlike everybody, I mean, I kind of like what's it called? What top tier is doing, because everybody else is just going to these third-party companies like DX Trades and everything else. And some folks were telling me that, I mean, look, the regulators or whoever is watching this, they're going to go wherever the flow is. So if everyone's migrating from one platform to the next, that this whole group of people are just kind of moving from one place to the next, they're going to attract the attention with them. It's a giant caravan of people moving. But TradeLocker, for example, these proprietary companies where you're going to trade on your own platform as opposed to having to rely on a third party, I think is actually better for customers because you're not going to get rug pulled the same way that if DX goes under, everyone is done. With TradeLocker, they can at least pause things. They can at least give out some communication that they have control over. So I don't know. At the end of the day, I support people who are building shit in this space and who have a legitimate interest in helping traders. And how you can tell right now is the influencer CEOs that are checked out that aren't providing a lot of clarity. There is not communication between the customers and the firms. Can't trust those folks. Only because it's like, bro, where the fuck are you? The folks that are actively working on solutions that are, they're trying stuff, they're taking the criticism, they're openly communicating, and they're kind of moving at top speed to go and find these new partnerships to get the show back on the road. They got a bright future. No matter what happens next, they will be winners. Would you recommend a profitable trader who's still a student to drop out? Look, anybody that answers that question for you does not care about you or your life. Okay, because there are so many things that go into a decision to drop out of school. And so just telling me that you're profitable is nowhere near enough information to recommend dropping out or staying in. How profitable, right? How long have you been profitable? A couple months of $10,000 weeks, you might start feeling like you're a god. That's how I was during the crypto days in 2017, where I started making plays to quit, to drop out of school and to start a company and to, basically become the next Zuckerberg. And then the market retraced in 2017, and all my 6 figures of floating equity went all the way back down to $10,000. Right? I quit my job at Merrill Lynch in 2021. The 3 months after was really 2.5 months. The 2.5 months after, I was losing money. I had 2 losing months in a row, up and down, closing good trades early because I just wanted to, I just quit my job and I don't want to, closing good trades early, holding the losers. Maybe it'll turn around. So there's a lot that goes into being a full-time trader, and you need to just, you don't need to be in a place where you're a profitable trader to go full-time. You need to be a profitable trader that has put enough money aside into other investments that you can go full-time. Because that cushion is the only thing that's going to give you the peace of mind or the mental clarity to keep trading your system. Ask about the difference in data feeds between Oanda and futures, specifically the occasional inconsistencies for liquidity sweeps and other manipulative elements. Naruto, great question. Mostly involving indices. Of course. Now, if you look at the first podcast I did with Dr. Olson, he actually went through liquidity and pricing. So I basically asked him, what is price? Like, what is price? Because when we're looking at the chart, it kind of seems like we're all looking at the same, everyone, there's a consensus about what the current market price of the NASDAQ is. The reality is there isn't. That's why different brokers and different feeds have different prices. They're all trying to get information from as many places in the world, from buying and selling data, to come up with an accurate idea of what the current price is. And the way he explained that shit to me was so crazy. The way he explained, God, he explained so much stuff. Like the biggest takeaway I got from Dr. Olson, me and Richard are like tight now, but the number one takeaway was fees. Because I kept trying to find the secret to the market. I'm like, how do I make money trading? What is the secret to how markets work? Because you gotta figure out exactly how markets work to run a brokerage of that size, or you have enough data at some point to know exactly how people are thinking and how people are acting. He told me fees. Fees are the hidden the thing that no one pays attention to. So if you look at compound interest, I'll do a compound interest analysis real quick, and then I got to hop off here. If you put $10,000 today into an investment and you were contributing $500 a month for 20 years until your retirement, and you were averaging a 7% interest rate per year with a 2% variability. Sometimes it's 5, sometimes it's 9. Okay? After those 20 years, your $10,000 plus the $6,000 that you're investing a year, the $6,000 a year, will be approximately $285,000. Okay? So from $10,000 to $285,000. The best case scenario is that you're sitting at 363. So the difference between 7% and 9% returns is almost 100 grand. The difference between 7% returns and 5% returns is 224 versus 280K. Okay, so this is all good. Now imagine you're getting charged a fee for withdrawing the funds. Let's say a 1% fee. Let's say you're getting charged a 1% fee, and then through all the swaps, through spread, through commissions and everything else, it adds up to another 1%. Okay, so now we'll go from 7 to 5. Okay, so we're going to go from 284,000 to 224,000 in the same amount of time. Okay, so you lost about 60 grand in potential earnings. On the top side, it went from 364,000, in the best case scenario, down to 280,000 in the best case scenario. So just 2% in fees, compounded over time, can have a dramatic effect on your overall results. And so he was just kind of highlighting the importance of fees in your trading strategy, because imagine how getting a late entry because of slippage impacts your risk and reward. Imagine how commissions impacts your overall profitability on the trade. And so your real risk and reward is actually less. Because let's say you made a 2-to-1, you risked 500 to make 500, but you had 100 in fees. So you really only made $400, but you risked 500. Your risk and reward is less than 1-to-1. Gabe said, ask him about the regulation environment in the US, what he sees the future of regulation for crypto and Forex. Gabe, that's my first question, bro. I'm gonna do a little intro with him, kind of walk him through exactly what's going on in our space. But that's the first question I'm interested in. Because you got to realize, Gabe, he built the regulatory environment in Europe. Like, retail traders did not have direct access to markets electronically before Oanda. And so having all these different brokerages listed on his platform, having them all on the same page, having the biggest banks in Europe on his platform all on the same page, and then basically onboarding consumers for a decade, he saw regulations start from the very beginning to the end. He was around this regulation evolution. I'm so fucking lit to go to ask him these questions and to find out the timeline of how the fuck we got here. I'm always a big fan of how did we get here. All right, ladies and gents, I'm actually going to protect my trade now. I'm going to do this on my phone here in a sec. I don't know why I'm doing it on the paper trade first. It's kind of priorities fucked up. All right, I'm going to do it on my phone too. Ladies and gents, happy and safe trading. If you learned something from this stream, please drop a like. Two important reminders. The second one is very important, so listen up. Number one, make sure to keep your risk management in check, especially going into March. We have the end of the month coming up here soon. The end of the month and beginning of the month are typically the most volatile. So don't go over leveraging and then blowing a hole in your account to start the month or to end the month. Deal? Number two, and this is something that I heard on the news this morning that's starting to circulate, is fxsummit2024.com to grab your tickets, early bird tickets to the FX Summit Conference, announcing the speakers this week. Very excited. You guys will obviously see that some of the podcasts I have booked this week will indicate some of the speakers for the summit that are already confirmed. It's going to be awesome. So make sure to grab your tickets. Once we start announcing speakers, prices will go to full price. fxsummit2024.com. See you guys tomorrow, bright and early, New York, live trading stream. And of course, mentioning New York, speaking of New York, I will be in New York this Friday for something very special. If you're available in New York, shoot us an email or shoot us a message on any socials. Let us know. And if there's enough interest, we'll set up a free workshop while we're up there. Okay. Happy, safe trading, everybody. Take it easy. Peace.